They tell you you're at a disadvantage. They tell you the game is rigged. They paint a picture of Wall Street as an impenetrable fortress, staffed by geniuses with supercomputers, trading in milliseconds, privy to information you could only dream of. They want you to believe you are a minnow in an ocean of sharks, and your only hope is to hand your money over to them, the professionals, the managers of the great and powerful hedge funds and mutual funds. They want you to believe that your smallness is your weakness. But today, right now, we are going to dismantle that lie. Because the single greatest investor of all time, Warren Buffett, built his entire philosophy on the opposite truth: that your smallness, your independence, your status as a retail investor is not a handicap. It is your single greatest strategic advantage. It is a superpower. The professionals, the ones in the glass towers, are not playing the same game as you. They are trapped in a prison of their own making, a prison with walls built of rules, regulations, and perverse incentives. Buffett gave this prison a name: the institutional imperative. It is the invisible force that compels large organizations to act in ways that are profoundly irrational, to mindlessly imitate their peers, to chase short-term performance at the expense of long-term wealth, and to ignore the most fertile hunting grounds in the entire market. They are forced to be stupid. You are not. This isn't just a feel-good story. This is a structural analysis of the market that reveals a massive, persistent inefficiency, an inefficiency that you, the individual investor, are uniquely positioned to exploit. By the end of this journey, you will no longer see the monolithic funds as competition to be feared, but as a predictable, lumbering herd whose forced mistakes create the very opportunities you need for life-changing portfolio growth. You will stop trying to copy the smart money because you will realize with chilling clarity that most of the time the smart money is forced to be the dumb money. You will learn to weaponize your patience, your flexibility, and your independence. You will stop playing their game, a game designed for you to lose. And you will start playing your own, a game you are built to win. This is the blueprint for how you beat 99% of Wall Street funds, not by being smarter but by being freer. Our journey begins with the most tangible, most brutally physical constraint that shackles the giants of Wall Street, the one that makes their billions a curse as much as a blessing. This is the first law of their prison, the curse of size and the prison of liquidity. A $10 billion fund cannot operate like a $50,000 individual. The sheer physics of capital makes it impossible. They are elephants trying to hunt in a field of rabbits. They can see the opportunities, but they are too big, too clumsy, too loud to ever catch them. This is where your advantage begins. In the shadows they cannot enter, in the small-cap stocks and ignored corners of the market where true wealth is so often cultivated. To understand this, we have to travel back in time, to a younger, hungrier Warren Buffett, a man who was not yet the Oracle of Omaha, but a small, nimble predator who used his size as a weapon. The year is 1962. The world is tense. The Cuban Missile Crisis is just around the corner. The stock market is a world away from the globally interconnected, high-frequency trading behemoth of today. It's a world of ticker tape, of research done in dusty libraries, of information traveling at the speed of the mailman. In this world, the 32-year-old Warren Buffett is running his small investment partnerships from a modest office in Omaha, Nebraska. He is a nobody to the titans of Wall Street, and that is his secret weapon. He wasn't managing billions, he was managing a few $1,000,000, a pittance by today's standards. And this allowed him to go hunting where the giants could not. His target was a company called the Dempster Mill Manufacturing Company. Dempster was the definition of a boring, unloved, small-cap stock. Based in Beatrice, Nebraska, they made windmills, irrigation equipment, and other farm implements. It was a classic cigar butt company, as Buffett would call them. A terrible business, available at a ridiculously cheap price. The company had been limping along for years, mismanaged and unprofitable. But Buffett, poring over its financial statements, saw something the rest of the world missed. The company was trading for around $28 per share. But Buffett calculated that its net current assets, Its cash, receivables, and inventory, minus all its liabilities, were worth over $72 per share. He could buy the company for one price and liquidate its most basic assets for more than double that. The factory, the brand, the machinery, all of that was free. It was a statistical certainty, a bet that was almost impossible to lose in the long run. Now imagine a $10 billion hedge fund today discovering a similar opportunity in a tiny $50 million company. What could they do? If they tried to invest just 1% of their fund, that's $100 million. They would have to buy the entire company twice over. Their very act of buying would be like a tidal wave hitting a bathtub. The stock price would rocket upwards before they could build even a tiny position, destroying the very value they sought to capture. They couldn't put a meaningful amount of capital to work without alerting the world and erasing their own edge. They are prisoners of liquidity. They can only invest in companies large enough to absorb their massive capital flows. The Apples, the Googles, the Microsofts of the world. But in 1962, Warren Buffett was small. He was nimble. He began buying shares of Dempster quietly, methodically. At $28, $30, $31, no one noticed. No alarms went off on Wall Street. He was a ghost. Over many months, he, through his partnerships, accumulated over 70% of the company's stock. He became the controlling shareholder. He then forced changes. He replaced the incompetent management, sold off unprofitable assets, and turned the lazy balance sheet into productive cash. Within 2 years, the value that was always there, hidden in plain sight, was unlocked. Buffett's investors made a spectacular return. This single investment, a move no large fund could ever dream of making, was a cornerstone of the fortune he was building. He wasn't just buying a stock, he was buying a whole company on the cheap, something only possible because he was fishing in a pond utterly deserted by the big players. This anecdote is not just a quaint story from the past, it is the foundational proof of your advantage. The world is filled with Dempster Mill manufacturing companies, small-cap gems hidden in plain sight, but the institutional giants are programmatically forbidden from ever touching them. The inability of large funds to invest in small companies isn't just a mechanical problem, it's a deep-seated psychological one. The brains of professional fund managers are wired to ignore these opportunities through a powerful cognitive bias known as the availability heuristic, compounded by a phenomenon called scope neglect. The availability heuristic tells us that our minds judge the likelihood of an event based on how easily we can recall examples of it. For a fund manager in New York or London, what's available? The news is dominated by Apple's new iPhone, Nvidia's chip advancements, and Tesla's latest production numbers. These large-cap stocks are perpetually in their information stream, their thoughts, and their conversations. They are cognitively, quote, available. A $200 million manufacturer of specialty machine parts in Ohio is not. It has no analyst coverage, no daily CNBC hits, no screaming headlines. To the fund manager's brain, it might as well not exist. They are operating under a self-imposed blindness, focusing only on the brightest, loudest stocks, because their environment makes it easy to do so. This is magnified by scope neglect. Let's say a portfolio manager at a $50 billion fund uncovers an incredible small-cap stock. He does the work, he loves the business, and he believes it can triple in 5 years. The company's entire market capitalization is $300 million. To make a meaningful impact on his $50 billion fund, he'd need to allocate at least 1%, or $500 million. He can't. He'd have to buy the whole company and then some. So what's the alternative? He could buy, say, $20 million worth. If the stock triples, that's a $60 million profit. It sounds like a lot of money to you or me, but to his fund, it represents a gain of just 0.12%. It barely moves the needle. His brain, and more importantly, his boss's brain, looks at the effort required to research and monitor this obscure company and compares it to the minuscule portfolio-level impact. The conclusion is swift. It's not worth the time. Scope neglect makes a phenomenal investment opportunity feel insignificant because its scale is mismatched with the fund's colossal size. This isn't a rational decision. It's a mental shortcut. The potential for a 200% return is ignored because the absolute dollar amount isn't big enough to matter to their denominator. Your denominator is small. A $20,000 investment that triples to $60,000 is life-changing. You are not shackled by the psychology of scale. So how do you turn this theory into a practical wealth-building strategy? You adopt a mental model we'll call the fishing in uncrowded ponds blueprint. This is a step-by-step process to systematically exploit the blind spots created by the curse of institutional size. Step 1 is the screen. You must use a stock screener. There are many excellent free and paid versions online, not to find good stocks, but to first eliminate the battlegrounds where you have no advantage. Your very first filter should be market capitalization. Set the maximum to $2 billion, or $1 billion, or, if you're truly bold, $500 million. With this single click, you have just excluded 99% of all institutional money. You have left the noisy, crowded, and hyper-efficient ocean of large-cap stocks and entered a series of quiet, uncrowded ponds. The elephants cannot follow you here. Step 2 is the qualitative analysis, where you become a connoisseur of the boring. Within this small-cap universe, you are specifically looking for simple, understandable businesses that Wall Street has no incentive to cover. Think about it. A Goldman Sachs analyst gets paid a fortune to cover a company like Amazon. There's huge client interest, massive trading volume, and a complex global business to analyze. That same analyst would see their career wither if they chose to cover a company that makes industrial fasteners or runs a regional chain of waste disposal sites. There's no glamour, no demand from big clients. This is your hunting ground. Look for companies with consistent, if unspectacular, earnings. Look for businesses that have been around for decades, quietly making money. Read their annual reports. Because they are so small, these reports are often shorter, simpler, and written in plain English. You can genuinely understand the entire business in a way you never could with a global conglomerate. Step 3 is applying your unique advantage in position sizing. Let's say you find a $300 million company you love, and you have a $50,000 portfolio. You can decide to make this a 10% position by investing $5,000. You can build that position over days or weeks, and your buying will be a drop in the ocean, completely invisible to the market. Now contrast that with the $10 billion fund. For them to make that same company a 10% position, they would need to invest $1 billion, more than 3 times the company's entire value. It is mathematically, physically impossible. Your ability to make a small company a meaningful part of your portfolio is a strategic power they can never possess. By systematically screening for size, focusing on the boring and uncovered, and building meaningful positions, you are playing a game that institutions are barred from entering. Now let's look at the dark reflection of this strategy, the antithesis, the path walked by 99% of investors. This is the large-cap comfort zone, and it is a trap. Most retail investors, influenced by the media and a desire to feel safe, do the exact opposite of what they should. They take their hard-earned money and buy the most famous, most analyzed, and most widely owned stocks in the world. Apple, Google, Tesla, Amazon, Nvidia. They are essentially choosing to compete on a battlefield where their opponents have every conceivable advantage. Think of it this way. Trying to find a mispriced large-cap stock is like trying to find a $20 bill lying on the floor of Grand Central Station at rush hour. The odds that you, with your internet connection and public filings, are seeing something that thousands of the world's smartest, best-paid analysts with direct access to company management have all missed is virtually zero. The price of Apple stock reflects an unbelievable amount of collective intelligence. It is, for all intents and purposes, efficiently priced. When you buy these stocks, you are not investing based on a unique insight. You are simply ratifying the consensus. You are playing in the most crowded pond imaginable, where every fish is a shark with better technology and more information than you. The path of the 99% is to mimic the institutions, believing that what is safe for them is safe for the individual. But they fail to realize the institutions own these stocks, not necessarily because they are the best investments, but because they are the only investments large enough for them to own. They are there by necessity, not always by choice. You, the individual, have the choice. To willingly enter the most competitive arena in the market when you have a golden ticket to arenas with no competition is a strategic error of the highest magnitude. The comfort of familiarity is the siren song that leads retail portfolios to the rocks of mediocrity. The financial connection here is direct, quantifiable, and has been academically documented for decades. It's called the small cap premium. Professors Eugene Fama and Kenneth French, in their Nobel Prize-winning work, identified that, over long historical periods, small capitalization stocks have tended to outperform large capitalization stocks. A separate factor, the value premium, showed that stocks with low valuation multiples, like price to book or price to earnings, also tended to outperform. When you combine these, you get the holy grail for the individual investor: small cap value stocks. This isn't some market anomaly or a statistical fluke. It is the direct financial reward for bearing the risks and illiquidity that large institutions cannot stomach. The outperformance of small-cap stocks is, in large part, a direct payment for the lack of attention from the institutional imperative. Because these stocks have fewer analysts, less media coverage, and are harder to trade in large quantities, they are often mispriced. The market for a $500 million company is simply less efficient than the market for a $2 trillion company. This inefficiency creates opportunities for diligent individuals to find dollars selling for 50 cents. The premium you earn is not magic. It's the wage you are paid for doing the work the big funds cannot do. It's the compensation for venturing into the uncrowded ponds. The balance sheet of a small company might hold hidden assets. The income statement might show a temporary dip in earnings that scares off the few analysts who cover it, creating a bargain. Your portfolio's growth over time can be massively enhanced by harvesting this premium, a premium that exists precisely because of the curse of size. The very structure of the market offers a tailwind to those who have the discipline to stay small, and you, the retail investor, are perfectly positioned to sail with it. If the curse of size is the physical wall of the institutional prison, the next constraint is the psychological torture chamber within it. This is the second pillar of their undoing, the tyranny of the quarterly report. The entire professional investment world operates on a frantic, self-destructive 90-day cycle. A fund manager is not judged on their wisdom over 5 or 10 years. They are judged on their performance this quarter versus their peers, and versus an arbitrary benchmark like the S&P 500. This relentless pressure forces them to make decisions that are often optimal for keeping their jobs in the short term, but catastrophic for building wealth in the long term. They are forced to trade noise, not signal. They are compelled to sell their biggest winners to lock in gains and make the quarterly statement look good. They are incentivized to avoid temporary pain at all costs, even if that pain is the necessary price of admission for spectacular long-term returns. Once again, we look to the master Warren Buffett for an example of how a truly independent thinker can exploit this institutional weakness, this forced short-sightedness. The setting is 1963. American Express is not the diversified financial titan we know today. Its primary businesses are travelers' checks and credit cards, both built on the bedrock of absolute trust. But this trust is about to be shattered. A company called Allied Crude Vegetable Oil, run by a swindler named Tino De Angelis, has perpetrated one of the biggest frauds in modern history. Allied had borrowed enormous sums of money from various banks, with the loans secured by barrels of salad oil held in warehouses. American Express, through a subsidiary, was in the business of inspecting these warehouses and issuing receipts that guaranteed the collateral existed. But Tino De Angelis was a con man of genius. His trick was simple. He filled the massive tanks mostly with water, with only a few feet of oil floating on top. The inspectors were fooled. When the fraud was discovered, Allied collapsed, and it turned out that 1.7 billion pounds of salad oil that was supposed to be in those tanks simply didn't exist. Wall Street panicked. American Express was on the hook. its subsidiary had guaranteed the collateral. The potential liabilities were enormous, possibly exceeding the entire net worth of the company. The stock, a blue-chip darling, collapsed. It fell by nearly 50% in a matter of weeks. The sentiment was utterly toxic. Every fund manager, judged on their quarterly performance, had a simple, rational decision to make: sell. Why would you hold a stock whose future was a massive, terrifying question mark? How could you explain to your clients, to your investment committee, that you were holding this toxic asset as it plummeted? It was career suicide. The institutional imperative screamed, "Get out now and ask questions later." But Warren Buffett, operating in his quiet Omaha office, was free from this pressure. He had permanent capital from his partners, who trusted his long-term judgment. He had no quarterly performance bogey to meet. He could think. So he did what the panicked managers on Wall Street couldn't. He went to work. He didn't just look at the stock chart, he investigated the underlying business. He went to restaurants and travel agencies. He talked to merchants. He stood on the docks and observed people using American Express travelers' checks. He saw that the salad oil scandal, while a huge and costly mess, had not damaged the fundamental earning power of the core business. People still trusted the American Express brand for their travels and payments. The franchise was intact. He concluded that the company could easily survive the financial hit and that its long-term value was far greater than the market's panicked, depressed price. So what did he do? He didn't just take a small position. He acted with conviction. Buffett invested 40% of his entire partnership's capital into American Express stock. 40%. Can you imagine a mutual fund manager today, in the midst of a terrifying scandal, investing nearly half his fund in a single, hated stock? He would be fired before the trade settled. But Buffett was playing a different game, a long game. He was engaging in what we now call time arbitrage, exploiting the market's myopic focus on the next 90 days. Of course, he was right. American Express survived, the scandal faded, the business grew, and the stock soared. It became one of Buffett's most legendary investments, a move that massively compounded his partners' wealth and cemented his reputation. He was only able to make it because he was not a prisoner of the quarterly report. The behavior of the Wall Street crowd during the salad oil scandal is a perfect illustration of a powerful and destructive cognitive bias, myopic loss aversion. The loss aversion part, first identified by psychologists Daniel Kahneman and Amos Tversky, shows that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. Losing $100 hurts more than finding $100 feels good. The myopic part refers to the time frame, when we evaluate our investments frequently, like every quarter, every month, or even every day. We experience this loss aversion over and over again. Every small dip in the stock price triggers that painful psychological response. A fund manager who has to report his performance every 90 days is living in a state of perpetual myopic loss aversion. The fear of reporting a loss for the quarter, the fear of angry clients and a demanding boss, creates an overwhelming pressure to avoid any and all short-term pain. This is compounded by another bias, hyperbolic discounting. This is our brain's tendency to prefer smaller, immediate rewards over larger, later rewards. The further away the reward, the more we discount its value. For a fund manager, the reward of keeping their job and collecting a bonus this year feels incredibly tangible and important. The potential for a massive gain on a stock in 5 years feels distant, abstract, and less certain. The immediate pain of holding a stock like American Express during the scandal far outweighs the discounted future pleasure of the eventual recovery. This combination is toxic. It forces them to sell great businesses at the point of maximum pessimism and prevents them from buying them, precisely when they are at their cheapest. Your freedom from this quarterly reporting cycle is a freedom from the psychological torture that creates these very bargains. To weaponize this institutional weakness, you need to adopt the time arbitrage framework. This is a mental model for systematically taking the other side of Wall Street's short-termism. Step 1 is to become a hunter of temporary problems. You must actively look for high-quality companies that are experiencing a crisis that you believe, after careful research, is temporary and solvable. This could be a product recall, an accounting scare, a failed drug trial for a pharmaceutical company with a deep pipeline, or a cyclical downturn in their industry. The key is to distinguish between a company with a temporary, fixable head cold and one with terminal cancer. The market, in its myopic panic, often confuses the two. Your job is to be the rational doctor making the correct diagnosis. Step 2 is to formalize your long-term thesis. Once you've identified a company you believe is temporarily undervalued, you must shift your entire mental time frame. Do not ask, "What will this stock do next quarter?" That is the loser's game. Instead, ask a different question. Based on the evidence, what is the probability that this business will be significantly more valuable in 5 years? Write the answer down. Create a one-page document outlining your thesis. Why is the problem temporary? What are the catalysts for recovery? What is the underlying earning power of the business? This act of writing it down solidifies your thinking and serves as an anchor against the inevitable emotional storms of market volatility. Step 3 is to implement a structural defense against your own emotional weakness, the no-look portfolio. For these special time arbitrage investments, you must make a pre-commitment. You might decide, "I will not sell this stock for at least 3 years, unless my original written thesis is proven to be fundamentally broken." This isn't about being stubborn, it's about forcing yourself to act like a true business owner and not a frantic stock quoter. By creating a rule-based system, you protect yourself from your own myopic loss aversion. You give your thesis the time it needs to play out, liberating you from the tyranny of the daily, monthly, or quarterly price quote. You are now playing the long game by design. The opposite of time arbitrage is the path of the 99%, performance chasing. This is the retail investor's version of the institutional obsession with short-term results, and it is just as destructive. Performance chasing is the simple, deeply ingrained human tendency to buy what has already gone up and sell what has already gone down. We see a stock or a fund that has had a spectacular run, and FOMO, the fear of missing out, kicks in. We project that recent past performance into the future and pile in, often near the very top. A perfect, painful example was the mania surrounding the ARK Innovation ETF in 2020 and early 2021. The fund, led by Cathie Wood, posted astronomical returns by investing in high-growth speculative technology stocks. The media celebrated her as a visionary. Money poured in from retail investors who were captivated by the incredible past performance. They were chasing the hot hand. But they were buying after the massive run-up, paying peak prices for the most popular stocks in the market. When the tide inevitably turned, as interest rates rose and the market sentiment shifted away from speculative growth, the fund collapsed. The very people who had chased performance on the way up were now faced with catastrophic losses. They were financially and emotionally devastated. This is the mirror image of the institutional mistake. The institutions are forced into this behavior to keep up with benchmarks. Individuals choose it out of greed and a lack of a disciplined framework. They are looking in the rearview mirror to drive their car, a strategy that always ends in a crash. By adopting the time arbitrage framework, you are consciously choosing to look through the windshield, 5 years into the future, a perspective almost no one else on the road is taking. The direct financial connection of this principle is the avoidance of the silent portfolio killer known as the volatility tax. This tax is not a government levy, it's the wealth destruction you inflict upon yourself through excessive activity. Every time you trade based on short-term news or panic, you incur costs. There are the obvious ones: brokerage commissions and the bid-ask spread. But the most insidious cost is taxes. Let's run a simple, powerful example. Imagine 2 investors, both starting with $100,000. Investor A is a time arbitrager. She buys a basket of quality stocks and holds them for 10 years, achieving a 12% annualized return. At the end of 10 years, Her portfolio is worth $310,000. She sells and pays a long-term capital gains tax, let's say at 15%, on her profit of $210,000. Her net after-tax amount is roughly $278,000. Now consider investor B, the performance chaser. He is hyperactive, trading in and out of hot stocks. Let's be generous and say he is a brilliant trader and also achieves a 12% gross return each year. But because he holds his stocks for less than a year, his gains are taxed as short-term capital gains at a much higher rate, let's say 35%. Each year, his 12% gain is reduced to a 7.8% gain after taxes. His capital compounds at this much lower rate. After 10 years, his $100,000 grows to only about $212,000. The difference is $66,000. That is the volatility tax. It is the massive, tangible financial price of short-term thinking. Your ability as an individual to adopt a long-term mindset and simply do nothing is not a passive act. It is an active, wealth-generating strategy that directly starves the taxman and allows the magic of uninterrupted compounding to work on your behalf. This is a mathematical advantage that the institutions, with their forced churn and window dressing, simply give away. We've seen the physical prison of size and the psychological prison of short-termism. Now we turn to the third, and perhaps most powerful, wall of the institutional cage, the herd mentality and the crushing weight of career risk. A professional fund manager's primary incentive is not necessarily to achieve the highest possible return for their clients. Their primary incentive is to keep their job. And the surest way to get fired in the investment management industry is not to be wrong. It's to be wrong alone. It is far safer for one's career to fail conventionally than to succeed unconventionally. If you buy the same popular stocks as every other fund and the market goes down, you can tell your clients, everyone lost money, it was a tough market. You will survive. But if you make a bold, contrarian bet on an unloved stock and it goes against you, even temporarily, there is no one to hide behind. You are the lone fool, and you will be fired. This powerful incentive structure creates a gravitational pull towards conformity, forcing almost all institutional money into the same crowded trades, creating massive bubbles and terrifying crashes. To see the power of resisting this pull, we must look at Buffett's most famous, most difficult, and most defining moment of contrarianism. The late 1990s. The internet was changing the world, and a speculative mania of historic proportions had gripped the stock market. It was the dot-com bubble. Any company with .com in its name, regardless of its business model or lack of profits, saw its stock price soar to absurd heights. It was a national obsession. Day trading was a new sport. People were quitting their jobs to trade stocks like Pets.com and Webvan. It felt like a new era where the old rules of valuation no longer applied. And in this environment, the institutional herd was running wild. Fund managers knew that if they didn't own technology stocks, they were going to dramatically underperform the benchmarks. And underperforming the benchmark meant losing clients and losing their jobs, so they bought. They bought anything and everything related to the internet, pushing valuations to levels that had never been seen before. And where was Warren Buffett? He was on the sidelines. He was being mocked, ridiculed. A famous cover story in Barron's in 1999 was titled, "What's Wrong, Warren?" The article suggested his value investing principles were obsolete, that he was a dinosaur who just didn't get it. His performance was lagging badly. Berkshire Hathaway's stock was underperforming the market by a wide margin. The pressure on him was immense. Lesser managers would have caved. They would have bought a few safe tech stocks like Cisco or Microsoft, just to have some exposure, just for career protection. But Buffett refused. He famously gave a speech at Sun Valley, the exclusive conference for media and tech moguls, where he calmly laid out the history of great American industries, from aviation to automobiles, and showed how revolutionary technology doesn't always translate into great returns for investors. He admitted he didn't understand the new internet companies well enough to value them. He was sticking to his circle of competence. He was willing to look like a fool, to underperform, to risk his reputation, because he would not be drawn into a game he didn't understand. We all know what happened next. In early 2000, the bubble burst. The Nasdaq, the index of tech stocks, collapsed by nearly 80%. Companies that had been worth billions were wiped out overnight. The fund managers who had herded into the mania were destroyed. And Warren Buffett, the dinosaur, looked like a genius once again. He had preserved his capital by refusing to join the stampede. This wasn't just about market timing. It was a profound act of psychological courage. He understood that in the world of investing, the crowd is often a source of danger, not wisdom. His freedom from career risk allowed him to make the truly rational decision, while everyone else was being driven by fear and greed. The institutional herd mentality is a direct consequence of the psychological principle of social proof. This is our innate tendency to assume that the actions of others reflect the correct behavior for a given situation. If you're in a foreign city and see a long line outside a restaurant, you'll probably assume the food is good. Social proof is a useful mental shortcut in many areas of life, but in financial markets, it can be lethal. When a fund manager sees every other respected fund buying a certain stock, their brain's social proof mechanism kicks in, telling them it must be a safe and smart thing to do. This is amplified by authority bias, our tendency to overweigh the opinions of those we perceive as authorities. When a famous, successful hedge fund manager announces a big position in a stock, other managers will often follow suit, outsourcing their own critical thinking to the perceived authority. The legendary economist John Maynard Keynes perfectly diagnosed the institutional dilemma when he wrote, "It is better for reputation to fail conventionally than to succeed unconventionally." This single sentence is the prime directive for 99% of professional money managers. It explains everything. It's why they all huddle in the same popular large-cap stocks. It's why they are terrified of being contrarian. Their goal is not to maximize returns. Their goal is to minimize career risk. And the best way to do that is to look as much like everyone else as possible. As an individual investor, you are gloriously free from this constraint. You have no career risk. You have no clients to answer to. You only have to answer to your own financial future. You can afford to be unconventional, to be a lone wolf, to be right when the whole world is wrong. To cultivate this contrarian mindset, you need a practical tool, the anti-portfolio exercise. This is a mental model designed to inoculate you against the virus of herd mentality. Step 1 is to actively track the hype. Create a virtual portfolio or a simple watch list, and in it, place the 10 most popular, most talked about stocks of the moment. These are the companies you hear about every day on the news, the ones everyone in your office is buzzing about. This is your herd portfolio. Step 2 is to apply the powerful technique of inversion. For each of these popular stocks, instead of doing what everyone else does and asking, "What's the bull case? Why should I buy this?" you will force yourself to ask the opposite question. What would have to be true for this to be a catastrophic investment over the next 5 years? Write down the answers. Would competition have to increase? Would their key product have to become obsolete? Would their valuation have to contract to historical norms? This exercise forces you to engage with the bear case, the one the euphoric herd is completely ignoring. It breaks the spell of social proof. Step 3 is to apply the circle of competence litmus test. For each of these hyped stocks, ask yourself one brutally honest question. Do I, an individual investor, genuinely understand this business and its future prospects better than the tens of thousands of the world's smartest, highest-paid professional analysts who cover it day and night? If the answer is anything other than an immediate and resounding yes, then you have no edge. You have no reason to be playing in that stock. You are simply gambling on the consensus. And that is a game you will not win. This 3-part exercise acts as a powerful psychological shield, protecting you from being swept away by the market's most dangerous manias. The retail investor's version of the institutional herd is the painful and destructive phenomenon of fear of missing out, or FOMO investing. This is the antithesis of a disciplined, contrarian approach. We saw it with the dot-com bubble, and we saw it again with the meme stock craze of 2021. Stocks like GameStop and AMC, which had questionable business fundamentals, were suddenly driven to unimaginable heights by a wave of retail buying, organized on social media platforms. The narrative was powerful. It was a movement of the little guy against the big hedge funds. People weren't buying because they had carefully analyzed the balance sheets. They were buying because of the story, the community, and an intense fear of missing out on what looked like easy, life-changing money. For a brief period, it worked. But for every person who got in early and made a fortune, there were thousands who piled in at the top, buying from those early investors, caught up in the social proof and the FOMO. They were left holding the bag when the bubble inevitably deflated and the stocks crashed back to reality. FOMO investing is pure emotion. It is the surrendering of individual reason to the madness of the crowd. It feels exciting. It feels like you're part of something. But it is the polar opposite of the professional, detached, and rational mindset required for long-term wealth creation. It is the path of the 99%, a path littered with broken accounts and shattered dreams. The direct financial connection here is the ability to profit from the bubble premium and crash discount that herd mentality inevitably creates. When a herd stampedes into a particular stock or sector, they drive valuations, price-to-earnings ratios, price-to-sales ratios, far beyond any connection to their underlying business reality. This is the bubble premium. A disciplined, contrarian investor who avoids these areas does more than just sidestep the eventual crash. They preserve their capital, which is the most valuable asset in investing. Rule number 1, as Buffett says, is never lose money. Rule number 2 is never forget rule number 1. Avoiding bubbles is the embodiment of this rule. Conversely, when the herd panics, as it did during the depths of the 2008 financial crisis or the COVID-19 crash in March 2020, they do the opposite. They sell everything indiscriminately, driven by fear. They sell wonderful, high-quality businesses at prices far below their intrinsic value. This creates the crash discount. For the investor who has preserved their capital and their sanity, this is the moment of maximum opportunity. Your financial advantage is realized by becoming the mirror image of the herd. You must be the calm seller of euphoria when they are greedy, and the aggressive buyer of despair when they are fearful. This is not about market timing in the short-term sense. It's about recognizing and acting on the multi-year cycles of fear and greed that are a direct, predictable result of the institutional imperative's need for social proof. Your portfolio's long-term returns will be determined not by your ability to find the next hot stock, but by your discipline in avoiding the herd's manias and your courage in exploiting their panics. We have now explored the external prison of size, the temporal prison of short-termism, and the social prison of herd mentality. But there is a fourth wall to this institutional cell, one that is built from within, the deadening weight of bureaucratic drag, and the subsequent sin of diversification. A large investment firm is not a nimble partnership run by a single brilliant mind. It is a sprawling bureaucracy. An investment idea from a bright young analyst must travel a perilous road before it ever sees the light of day. It has to be approved by a portfolio manager, vetted by a risk management committee, checked by the compliance department, and perhaps presented to a chief investment officer. At each stage, the original bold idea is sanded down, compromised, and diluted, all in the name of consensus and safety. This process actively filters out the very type of concentrated, high-conviction ideas that generate market-beating returns. And the end result is a portfolio that is a pale imitation of a good idea, a massively over-diversified collection of mediocrity. To understand the power of escaping this bureaucracy, we can look at a lesser-known but crucial part of the Berkshire Hathaway story, Lou Simpson. For decades, starting in 1979, Simpson was the chief investment officer of Geico, the insurance company owned by Berkshire. Warren Buffett, the ultimate micromanager in many ways, gave Simpson almost total autonomy over Geico's massive stock portfolio. Buffett's instruction was simple: run it as if it were your own money. Simpson was a one-man investment committee. He didn't have to get approval from a board or justify his decisions to a compliance officer. He was free to act on his best judgment. And what did he do with this freedom? He ran a portfolio that would give a modern risk manager a heart attack. It was highly concentrated. At times, he had over half of his multi-billion-dollar portfolio in just 5 stocks. He believed, as Buffett did, that diversification was a protection against ignorance, and if you knew what you were doing, you should concentrate your capital in your very best ideas. His results were staggering. Over his 25-year tenure, he earned an average annual return of 20%, crushing the S&P 500's return of around 13%. He was a Hall of Fame investor operating within the Berkshire ecosystem. Now, contrast his approach: concentrated, autonomous, decisive, with a typical large mutual fund. That fund might own 200, 500, or even 1,000 different stocks. The manager's best idea might be a mere 1.5% position. Even if that stock doubles, its impact on the total portfolio is negligible. The entire structure of the large, bureaucratic firm is designed to produce average index-hugging returns, minus their high fees. Lou Simpson's success is a testament to the power of concentrated, independent decision-making, a power that is systematically destroyed by institutional bureaucracy. The psychological principles at play within these investment committees are groupthink and the diffusion of responsibility. Groupthink, a term coined by psychologist Irving Janis, describes a phenomenon where the desire for harmony and conformity within a group results in an irrational or dysfunctional decision-making outcome. Dissenting opinions are discouraged, and critical evaluation of ideas is suppressed in favor of reaching a consensus. In an investment committee, an analyst with a bold, contrarian idea might be hesitant to speak up for fear of being seen as a troublemaker or not a team player. The pressure to agree with the group's prevailing view is immense. This is coupled with the diffusion of responsibility. When a decision is made by a committee of 10 people, and that decision turns out to be wrong, no single individual feels the full weight of the failure. The blame is spread thinly across the group. "We all agreed it was a good idea," they can say. This psychological cushion makes it much safer to approve a mediocre consensus idea than a bold, unconventional one. If the consensus idea fails, no one gets fired. If the bold idea fails, the person who championed it is clearly to blame. This entire structure creates a powerful incentive to be average. It is a machine designed to kill great ideas and promote diversification, diversifying so broadly that your portfolio is guaranteed to do no better than the market average. As an individual, you are the chairman, CEO, and sole member of your own investment committee. You can escape this trap. To harness this freedom, you must adopt the mental model of the CEO of your own portfolio. This means treating your investments with the seriousness and accountability of a chief executive running a business. The first rule of this model is Buffett's 20-slot punch card rule. Imagine that at the beginning of your investment life, you are given a punch card with only 20 slots on it. That's it. You get 20 investment decisions for your entire life. Once you've punched all 20, you can't make any more. This thought experiment is incredibly powerful. It forces you to reject mediocrity. You wouldn't waste one of your precious 20 punches on your 50th best idea. You would wait patiently for an idea that was so compelling, so thoroughly researched, and so attractively priced that you were willing to commit one of your life's few decision slots to it. This is the ultimate antidote to diversification. It forces concentration and extreme discipline. Step 2 is to implement rigorous investment journaling. For every single stock you decide to punch your card for, you must write a 1 to 2 page investment memo to yourself. This is not optional. The memo should clearly and simply state the business thesis. Why is this a great company? It should identify the key risks. What could go wrong with this thesis? And it should lay out a rough valuation. Why do you believe the stock is cheap? And what do you think it is worth? This process does two things. First, it forces clarity of thought. If you can't explain the investment simply on a piece of paper, you don't understand it well enough to own it. Second, it creates personal accountability. Months or years later, you can go back and review your memo. Was your original thesis correct? Did the risks you identified materialize? This feedback loop is crucial for learning and improving as an investor. You are creating your own performance review. Step 3 is embracing the discipline to kill your darlings. As the CEO of your portfolio, you must be a ruthless capital allocator. This means regularly reviewing your holdings and your original memos. If the facts have changed and your original investment thesis is now broken, you must sell, regardless of the price. Emotions like hope or the desire to get back to even have no place in this decision. Similarly, if a new, far superior opportunity comes along, an idea so good it deserves one of your 20 punches, you must be willing to sell a lesser idea in your portfolio to fund it. You are the sole committee member. There is no bureaucracy. You must act with the decisiveness that this freedom allows. The antithesis to this CEO mindset is the collector's mentality, which is how the 99% of retail investors operate. They don't see themselves as running a concentrated business. They see themselves as collecting stamps or baseball cards. They buy a little bit of this because they heard a tip, a little bit of that because it was in the news. They end up with a portfolio of 50, 100, or even more stocks. They can't possibly keep up with the news, let alone the quarterly and annual reports. For all these companies, they have no coherent strategy. This is diversification in its purest form. Their best ideas, even if they have them, are starved of capital because they are only a tiny fraction of the portfolio. Their worst ideas, the darlings they can't bring themselves to sell, act as a permanent drag on performance. The collector's portfolio is a chaotic, unmanaged mess, destined for mediocrity. It is the result of activity without discipline, and it guarantees that the investor will never achieve the market-beating returns that concentration makes possible. The direct financial connection of this principle is found in the mathematics of geometric returns. Building serious wealth requires not just good returns, but lumpy returns. Your portfolio's long-term performance will be disproportionately driven by a few big winners. Concentration is the only way to ensure these winners have a meaningful impact. Let's look at a simple simulation. Portfolio A is the diversified collector's portfolio, with 100 stocks, each a 1% position. Portfolio B is the concentrated CEO portfolio, with 10 stocks, each a 10% position. Now let's say both investors are brilliant and each finds one incredible stock that increases six-fold, a 500% gain. In Portfolio A, the 1% position that goes up 500% adds 5 percentage points to the total portfolio's return. It's a nice boost, but it's not transformative. The other 99 mediocre holdings will dilute its impact almost to insignificance. In Portfolio B, the 10% position that goes up 500% adds 50 percentage points to the total portfolio's return. This single decision dramatically alters the long-term trajectory of the entire portfolio. It is a wealth-creating event. The math is undeniable. Wealth is not built by avoiding all errors. It is built by ensuring that your correct insights are large enough to matter. The bureaucratic structure of institutional funds forces them into the model of Portfolio A. Their need for diversification is a mathematical anchor on their returns. Your freedom as an individual allows you to structure your portfolio like Portfolio B, giving you a direct arithmetic advantage over the pros. We have now deconstructed the four walls of the institutional prison: size, short-termism, herding, and bureaucracy. We have seen how these constraints force large funds into self-destructive behavior. This brings us to our fifth and final pillar, where we consolidate your advantage. This is the synthesis of everything we have learned. We will call it the individual's asymmetric arsenal, and its primary weapons are patience, concentration, and inactivity. These three tools are simple, powerful, and almost impossible for a professional fund manager to wield. For you, they are the keys to unlocking the market's greatest opportunities and achieving true financial freedom. And, as always, a story from Buffett's life shows us the way. The year is 1973, the market is in turmoil. The Nifty 50 bubble is burst, the Vietnam War is raging, and an oil crisis is crippling the economy. It's a time of deep pessimism, very much like 2008 or early 2020. In this environment of fear, Buffett turned his attention to the Washington Post company. The Post was a phenomenal business. It had a dominant, near-monopolistic position in its market with the flagship newspaper, and it also owned Newsweek magazine and several valuable television stations. But the stock market hated newspaper stocks. They were seen as old media, boring and ex-durable. And in the midst of the market crash, the Post's stock had been thrown out with the bathwater. Buffett did his analysis and calculated that the entire company was selling in the stock market for about $80 million. But he also calculated that a single one of its television stations, if sold on its own, would likely fetch more than that. By buying the stock, he was essentially getting the Washington Post newspaper, one of the world's most prestigious journalistic institutions, plus Newsweek magazine, plus the other television stations, for free. It was a classic Buffett fat pitch, an obvious, glaring mispricing created by market panic, so he acted with conviction, our weapon of concentration. He invested over $10 million, a huge sum for Berkshire Hathaway at the time, and bought up more than 10% of the company. And then he deployed his other two weapons, patience and inactivity. He didn't trade the stock, he didn't worry when the price stagnated for the next couple of years. He didn't get calls from angry clients demanding to know why he owned a boring newspaper stock. He just sat. For years and years. He knew he owned a wonderful collection of businesses purchased at a ridiculous price. His job was not to outsmart the market on a daily basis. His job was to let the value of the underlying businesses compound over time. And compound it did. The initial $10 million investment would eventually become worth over $1 billion. It was one of the single greatest investments of all time, and it was made possible only by the combination of the three weapons in the individual's arsenal: the courage to concentrate when the opportunity was obvious, and the incredible patience and discipline for inactivity to let the thesis work for decades. This ability to wait, to do nothing, is directly linked to one of the most famous experiments in psychology, the marshmallow test. In the 1960s, psychologist Walter Mischel at Stanford University tested the willpower of young children. He placed a marshmallow in front of a child and told them they could eat it now, or, if they could wait for 15 minutes until he returned, they could have 2 marshmallows. It was a simple test of delayed gratification. The follow-up studies years later were groundbreaking. The children who had been able to delay gratification and wait for the second marshmallow went on to have higher test scores, better health, and more success in their careers. The ability to resist the impulse for an immediate, small reward in favor of a larger delayed reward is a massive predictor of long-term success in life. Investing is the ultimate marshmallow test for adults. The market constantly dangles one marshmallow in front of you. The temptation to do something, to trade a hot stock, to react to a news headline, to sell a stock that's down a little to stop the pain, is immense. This is the immediate, small reward of feeling active and in control. The 2 marshmallows, the much larger reward, is the wealth that comes from long-term, uninterrupted compounding. But that reward is years, even decades, in the future. The entire institutional investment complex is built to fail the marshmallow test. The quarterly performance pressures, the need to show clients you are active, the career risk. It all forces them to grab the first marshmallow every single time. As an individual, you have the power to master your own impulses, to wait for the second, third, and fourth marshmallow. Your patience is not a passive virtue, it is an active financial weapon. So how do you build a system to deploy this arsenal? You use the sit-on-your-hands strategy. This is a 3-part mental model to cultivate the discipline of patience, concentration, and inactivity. The first part is creating your too hard pile. As investment ideas come across your desk, from the news, from friends, from your own research, your default action should be to say no. 99% of all opportunities should be immediately discarded into a mental, or even physical, too hard pile. Is the business too complex? Too hard pile. Is the industry changing too rapidly? Too hard pile. Is the company's success dependent on a single genius CEO? Too hard pile. This practice isn't about being lazy. It's about conserving your precious mental energy and capital for the rare, truly exceptional opportunities. It cultivates the crucial discipline of saying no. The second part is internalizing the fat pitch waiting game. Charlie Munger, Buffett's longtime partner, describes their investment style using a baseball analogy. In regular baseball, a batter has to swing at any pitch in the strike zone, or they get a strike called against them. But in investing, you can stand at the plate all day, and the pitcher can throw thousands of pitches, and you never have to swing. There are no called strikes. You can wait and wait and wait for the perfect pitch, the fat pitch right down the middle, the no-brainer opportunity like the Washington Post in 1973. This might mean you do nothing for a year, or even 2. It requires immense patience, but your goal is not to get a lot of base hits. Your goal is to wait for the one pitch you can hit out of the park. Most investors feel the need to be constantly swinging. You must cultivate the wisdom to wait for the opportunity where the odds are overwhelmingly stacked in your favor. The third and final part is to automate and forget. For most people, the urge to do something is too strong to resist entirely. So channel it productively. Set up automatic, recurring investments into a simple, low-cost S&P 500 index fund for the majority of your capital. This is your wealth-building engine. It puts your money to work, satisfies your action bias, and ensures you participate in the market's long-term growth. This automated core portfolio runs on its own, freeing up your mental bandwidth to patiently wait for the fat pitch opportunities for your smaller, concentrated play portfolio. This two-pocket approach separates your disciplined, long-term compounding from your opportunistic, market-beating activities. It is the practical system for sitting on your hands without going crazy. The antithesis to this patient, disciplined approach is the action bias, the path of the 99%. Our brains evolved in an environment where taking action, running from a predator, hunting for food, was almost always better than doing nothing. This bias is hardwired into our psychology. In the modern world of investing, it is a catastrophic flaw. It manifests as constantly checking your portfolio, tinkering with your holdings, selling a stock after a small gain, or panic selling after a small loss. It feels productive. It feels like you are in control. But in reality, it is usually just noise. Most of the time, the single best action you can take for your portfolio is absolutely nothing. The 99% believe that more activity equals more success. The 1% understand that profitable investing is mostly profitable waiting. They have conquered their own innate action bias. And this brings us to the ultimate direct financial connection, the almost mystical power of uninterrupted compounding. Albert Einstein is apocryphally said to have called compound interest the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Your single greatest financial advantage as an individual investor is not your stock-picking ability. It is your long, uninterrupted time horizon. A fund manager's time horizon is the next quarter. Your time horizon can be the next 40 years. Let's look at the staggering financial power of this difference. Imagine an investor who, through hyperactive trading, manages to generate a fantastic 15% annual return. But because they are constantly trading, they are frequently in cash, they pay high taxes, and they panic sell during crashes, interrupting the compounding process. Now imagine another investor, a patient one, who achieves a more modest 12% annual return, but they never, ever interrupt the compounding. They buy and hold. They sit on their hands. Over 1 or 2 years, the hyperactive trader might be ahead, but over 30 years, the patient investor will have vastly more wealth. The uninterrupted compounding at a slightly lower rate is mathematically more powerful than the interrupted compounding at a higher rate. The interruptions, the taxes, the fees, the panics, act as a massive anchor on long-term growth. Patience and inactivity are not just philosophical virtues. They are the tools that guard the sacred process of compounding. By simply refusing to act, by letting your capital work for you across decades, you unlock a force of wealth creation that no institution, with its frantic, short-term dance, can ever hope to match. You have made it to the end of this journey, and in doing so you have acquired a new and powerful lens through which to view the entire world of finance. You now possess the mental model of the institutional imperative. You will never again look at a billion-dollar hedge fund with envy or fear. You no longer see yourself as a small fish in a big pond, but as a nimble predator in an ecosystem where the whales are trapped, blinded, and hobbled by their own size and their own rules. You understand that their need for liquidity, their obsession with quarterly performance, their terror of career risk, and their soul-crushing bureaucracy are not your disadvantages, but are the very source of your greatest opportunities. You are free, and they are not. But understanding why they are forced to fail is only the first layer of mastery. The second, more crucial layer is mastering the specific, practical techniques that allow you to spot and analyze the incredible bargains they are forced to ignore. Knowing that the pond is uncrowded is useless if you don't know what a prize-winning fish looks like up close. The framework you have just learned is the why. The next essential step is the how. The video that YouTube is now recommending for you on the screen is not an accident. Its algorithm has detected that you are serious, that you have invested the time to go deep. It is designed to be the next piece of the map. It is the bridge that connects the strategic understanding you've just gained with the tactical, numerical skills required to execute it. It is the link between identifying the market's structural weakness and exploiting it with a concrete, disciplined process. Many people will stop here, content with the theory. They will feel smart for a day and then go back to their old habits. But for those of you who are not just students of the market, but are on a deliberate path to building true financial freedom, this next step is not optional. It is the continuation of your ascent. It is the commitment to turning knowledge into power. The choice is yours. The click is not just to watch another video. It is to continue your transformation and complete your mental arsenal. Click the video and take the next step.